Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs data this week and what's happening to mortgage rates as that comes in. Logan, welcome back to the podcast.
It is wonderful to be here. By the time this podcast comes out, jobless claims will be out. The ADP report will came out, but labor overinflation, new year-to-date mortgage rate lows after the job openings report.
The job openings report, so that missed estimates, not by a lot, but tell us what happened there.
So the job openings report is a controversial report. A lot of people hate it because they think it's fake. They don't think there's that many job openings, but the Federal Reserve loves it, and I love it because it's like the purchase application data. It's basically a trend survey. So it does tell you if the labor market's hot or getting colder. Well, today, for the first time since 2021, we have more unemployed workers than job openings. And that's critical because the Federal Reserve really put their hat on that data line for so many years. For those that remember the COVID-19 recovery model, the labor recovery had job openings getting up to 10 million in that. And we were talking about that in 2021. It got up to 12 million. Well, it's back down to 7.2 million. We're kind of back to the pre-COVID era. But the data line that the Federal Reserve loved to hold their hat on is basically we have more unemployed workers than job openings. Manufacturing jobs are slowly being lost for some time. Residential construction jobs are slowly being lost. The Federal Reserve now are coming out and saying, well, if we just get 30 to 50,000 jobs, it'd be okay. So this isn't the solid labor market that they're talking about for so many years. And I think it's just hard for some of them to make that next stage because jobless claims are still low and the unemployment rate is still low. So very fascinating week, especially for us that are labor over inflation. It does explain why mortgage rates are at year-to-date lows. Of course, mortgage spreads are the key beneficial variable in that equation.
So the year-to-date low so far is 6.49%, correct?
Yes, and
Okay.
that just happened this morning. The 10-year yield, last time I checked, was at 4.21. It has been very difficult for the 10-year yield to close below 4.18% and then head that next stage lower. Of course, the Fed raised their inflation expectations this year, and they've been correct, right? They had 3% inflation. CPI core is at 3.1%, PCE is at 2.9%, but the labor data is overriding inflation. If only one person talked about that for
Who
so
could
many
that
years.
be?
Who could that be? In any case, it becomes a little bit more fascinating Jobs Friday for the payroll report because I've been saying that, listen, it doesn't take much to beat expectations. I'm not talking about the expectations of the report, but just, how much worse can it get from 35,000 jobs on a 3-month average? So it just makes it more interesting. Like everything else, Sarah, after July 1st, 2025, we said the second half it's going to be lit. And that's what it's been here all along.
It has. Okay, so let's talk about job openings because they climbed after COVID, right? Obviously, lots of people were out of work. There were just so tell us where we came from, where we are today, and what you make of that.
Okay, so job openings is very critical to my work, especially in the last decade. I remember like in 2016 writing about job openings are going to hit 6.21 million just because, the baby boomers are leaving the workforce, right? They need to be replaced. If they're replaced, it's basically a wash. So job openings, of course, back then in the last decade, the anti-central bank movement was like, there's 96 million people out of work. We had some really crazy people in the last decade as well. And so not a lot of people took that job openings data seriously, but it ended up being the longest economic and job expansion in the history of America because none of the labor triggers ever went off. Not even the sixth recession red flag was even triggered, even for a very brief time. But in COVID, because you have people dying, you have the COVID-19 variable of a health scare. We had all the jobs being lost to COVID. We thought it would be September of 2022, just because the vaccines and everything, and get everything. We should get all that jobs back. But we thought job openings from 7 million, of course, it crashed when COVID, but then recovered. We could get to 10 million. It got to 12 million. We're 12 million. We're now down to 7. 7 is pre-COVID level, 7.2 million. So we're basically there. But I always say that, when we wrote that in the article, the Federal Reserve does not like wage growth above 3%. Because if you people make more money, Sarah, what will you do if you make more money?
You'll buy a
You'll
house,
buy
you'll start a
stuff.
family, yeah.
Yes, you'll buy stuff. And if you buy stuff, like Neil Kashkar said, how are we supposed to balance an economy if people have 6% mortgage rates and they buy homes and they have sex and they go to IKEA and they buy stuff? How are we supposed to do that? So wage growth at 3%, 1% productivity, 2% inflation targets. I don't make the rules, but that's what they're going with, right? And so the attacking of the labor supply, like, to me, I always say the Fed smiles because, you cannot allow people to have strong wage growth because that'll be inflationary. They always say wages aren't inflationary right now, but really, you could go back in thousands of statements. Attack the labor supply. Wage growth is too strong. Wage growth is too strong. So you want to keep an eye on the wage growth data because a lot of people say, well, if population growth is really slowing down and there's not a lot of people looking for work, then obviously the people that you want to keep, you have to pay them higher wages. Now, with inflation picking up, the cost of living goes up, so that's the wage growth variable in there. So a fascinating time for the labor data, but this one was probably one of those ones where the Fed's like, oh, we have to maybe change our tune just a little bit. But you definitely have a divide within the Federal Reserve about those who say 30,000 to 50,000 jobs is perfectly fine. If we only create 30 to 50,000 jobs for the next 100 years, we're perfectly okay. But in this case, there's other people that says, well, manufacturing jobs are being lost, residential, there are sectors of our economy that are actually shedding jobs already, and policy is too tight for this. So the conflict, the fight, the civil war between this group and that group on the Federal Reserve, and Trump's attempt to take over the Federal Reserve Board and push down, so one of our listeners caught on to what I'm saying. If it's very hard for the 10-year yield to get below 4.18%, but if they cut the Fed funds rate 3 more times, that 5-year, 7-year arm looks a lot good. People don't want to wait. And you got sub 6% mortgage rates. And, these arms aren't the arms of the past. You got to qualify for the recast. So, people are starting to pull the trigger on this. And this is why we highlight that, Trump's policy might be for arm lending growth than the 30-year fix. So a lot's going on, but Jobs Friday is coming up. And again, it's just been very hard to break under 418. So we'll see if that happens this Friday.
Okay, so I want to dig into something that you said about some of the Fed comments. Like, so obviously 35,000 jobs. The fact that we had that revised jobs report that said for the last 3 months, only 35,000 jobs a month had been created. And then today we got somebody from the Fed talking about, oh, if it was 30,000, that would be okay. What is that?
Yeah, Fed Musa has. Yeah, so some of the Fed presidents are giving their run rate, which means with the population growth where it is, where they think it's acceptable for job growth, just to the replacement rate. So some people have 50 to 75,000. Fed Governor Musa had 30 to 80. So that's a kind of a little bit of wide range. But the fact that he said 30,000, that 30,000 jobs a month for the rest of the history of the United States would be perfectly acceptable with population growth. It's like, so again, what do we always say since 2022? The Federal Reserve needs the labor market to break,
Right.
to get dovish again. Like, all we're talking about is getting to neutral policy, like neutral policy. We're not even talking about. So we have this huge fight. Any other time in history with these jobs numbers, with manufacturing jobs being lost, you would have a different take. But I just think this group of Federal Reserve struggles with this, because of the inflation. Inflation took off, which is pandemic inflation, right? They shouldn't hold that. It's pandemic inflation and the disinflation happened, right? It wasn't because of them. That's just the function of pandemic inflation moments. Now what, right? I mean,
What?
jobless claims is the last line of defense. If jobless claims start to take off, it doesn't really matter. The bond market goes lower and the Fed plays catch up. So it is going to be critical to watch these last final labor triggers if they start to pull on the Federal Reserve anytime soon.
Okay, so what do you think that that number should be? Instead of 35,000, what should that be?
I have a run rate at 78,000.
Okay.
And again, a lot of people just aren't sure what the population data is because, tracking stuff lately hasn't been excellent. But see, the thing is that if I'm saying 78,000, that's not a solid labor market. That's an excuse, right? So a few months ago, I said, you know what? The jobs data is underperforming my estimates this year. This is before all this happened. And I said, this is the first time in this recovery that the jobs data was underperforming. Last year, the jobs data was outperforming my estimates, but the revisions, everything back came down to the level that I thought we should grow. This year wasn't even the case. And then it's not coincidence that we're having this discussion as manufacturing jobs are being lost and residential construction jobs. If it wasn't for AI data centers, you'd have even less construction workers in total,
True.
right? But the AI data centers are since Chat GBT was created, the spending in data centers have just taken off. So every cycle is unique. This is no different. This has different variables that we're accustomed to, but we'll see. I mean, again, until that 418 level breaks, I'm skeptical of rates going much lower. But clearly, this Federal Reserve needs more labor damage. If they're accepting 30 to 50,000 as okay, it's fine, then there needs to be a broader discussion on this going out in the future.
Okay, so, what do you think the best case scenario for rates are on Friday? If we get not a great report, what do you think the best case scenario is?
I always say the best case for mortgage rates are jobless claims data. Jobless claims data is literally there's no hiding behind any number with jobless claims. If that thing starts heading toward 323,000, the 10-year yield does all of its stuff. So when this report comes out or when this podcast comes out, we'll get the jobless claims data. But however, also it's such a low bar to beat. I mean, these jobs reports, you could have we could have 125,000 jobs created on Friday, and that look amazing compared to last, but that it would still technically be under my estimates for this year. So it's one of these toss ups that who knows how the bond market's going to react, because we just had the 3 months of the lowest job growth in the 21st century without a negative report. We already have manufacturing jobs being lost. We already have residential construction. So you can't go any lower than this, than kind of recessionary data. So the labor market's not breaking, but it's very soft in terms of hiring. So the question is, what's next? Because all we're talking about is the Fed getting to neutral policy, maybe in 2026 or 2027. Christopher Waller had a few statements out today, and he says my neutral rate is much lower than other persons. The Civil War is real, right? The Civil War is
The
real,
one within the
and Trump's
Fed.
trying to get as many of his people into the Federal Reserve to override Powell. Not only that, but override the Beth Hammocks of the world, the Moosas of the world, all these other Fed governors. And the conflict is going to be here. And just imagine when Trump's people are in the Federal Reserve, how chaotic those minutes and stuff are going to be.
Okay, well, when I was asking, what's your best case scenario? Let's talk rates. Okay, so say, what do you think is going to happen with rates? How low can they go? Are we
I,
there?
I I cannot get rates much lower until I can see evidence that we can break below
Okay.
418 on the 10-year yield. I mean, it's just right now the 2025 range was 5.75 to 7.25, right? We believe in ranges and waves and models and 10-year yields and spreads, and if the spreads are good this year. So right now we're already a little bit more than halfway through the low point of the year. So to me, you just need real weaker data to warrant the 10-year yield breaking below 418 and heading lower, because now that's going a little bit ahead of Fed policy right now. See, last year, 10-year yield was at 360. If we had 360 and mortgage spreads this year, we're sub 6% mortgage rates today, if that was the case. But that's not the case, even though the jobs data is softer. inflation expectations rose this year. So this is kind of the tug of war line right now. So you really need a weaker report to get rates much lower than here, because the Fed is staying very firm about inflation. And there's not enough voters right now on the board to override Powell's and the other Fed governors who don't want to cut rates. There's a lot of Fed governors who do not want to cut rates, and they're saying it, screaming on it on their speeches and talking points. So we'll see. It's a much more efficient pricing this year on the 10-year yield than last year. Last year, everyone kind of freaked out and everyone thought we're 100% we're going into a recession, but that wasn't the case, clearly.
I mean, if we're gonna plateau at a mortgage rate, 6.49 is way better than it has been at some points, but obviously we'd love to see it go closer down to 6%.
So what we've seen always in the data, because purchase application data came out, housing data tends to perform better when rates get below 6.64. And now that we have 5 weeks of data, we do the weeklies. We have 4 positive weeks, 1 negative week. We have 5 straight weeks of year-over-year growth that are both double digits, right? 17% today, 25% last week, So the longer it stays below 6.64 and heads down, the better the housing data has looked in the past. This is after 2022. We're not talking anything before that, because rates never got below 6% in the last decade, or never were above 6% in the last decade. So that's all we can work with. So we'll see. Again, this is one of these things where it really is a battle of the test of the wills of the Fed. But if jobless claims start to head up higher, nothing matters. Bond
Yep.
markets will head like they did last year. Last year, people, even though the jobless claims data wasn't really breaking, the 10-year yield was so ahead of Fed policy that any kind of stabilization in the data shot right backs up, as they should have. But this year, we don't have that, 360, 370 10-year yield. We really have a hard time breaking under 14. The only time we did it was Godzilla tariffs, and Godzilla tariffs were just, we had a bear market in stocks. People were talking, like, all hell broke loose. You want to discount that from the data lines, because that isn't here.
We'll be keeping a very close eye. You wrote a story today about the new low mortgage rate for the year. Everyone keep an eye out there, and also listen in, because that's what we're talking about this week.
Yep. Jobs Friday is coming up. We always love Jobs Week, and this is the last Jobs Week before the Fed meeting. So
Huge.
all these data is going to really stick for them.
All right, Logan, thank you so much for being on.
Pleasure.